Some of the basic ratios used in planning analytical procedures are the gross margin analysis, which I talk about quite a bit. It's very important to do. But also days sales outstanding, DSO. Its real name in our books is turnover of receivables, which is really figuring out the number of sales that accounts receivable has been outstanding. So in the real world, a lot of times they call that DSO, or days sales outstanding. The average receivables balance per customer. Receivables is a percentage of current assets or total assets. That aging of receivables, again, very important. Understanding also that allowance for uncollectible accounts as a percentage of accounts receivable and comparing that over the couple of years. What debt expense is per net credit sales. It's a good ratio. Sales in the last month compared to the total sales. Sales discounts compared to credit sales. And finally, returns and allowance as a percentage of sales. These are all ratios that you should calculate on the audit, review, see if there's been any significant changes from past periods or past quarters. Some other trends that the auditor should keep their eyes on related to the planning analytical procedures is monthly sales analysis compared with past years and budgets. How are they doing compared to the past or the budgets? Also identify spikes at end of quarters. Spikes usually mean some sort of push to the market. That's when fraud potentially exists, fictitious invoices, sales that really didn't occur, those types of things. And then trends on discounts allowed to specific customers even, but then comparing it as a whole to your experiences or industry averages, things out there, so that it makes sense, these discounts that they're allowing. One of our first steps is always testing controls, so the auditor will select both entity-wide and transaction controls for testing. So the typical tests of transaction controls include inquiring of personnel performing that control, observation of the control being performed, inspection of the documents to confirm that the control has been performed, and then potentially reperforming of that control by the individual testing that control. So reperformance, a lot of times, is that last step the auditor will do to test that control. These are just some typical substantive tests that you get into. Sales transactions, understanding whether they actually do exist and they're properly valued. You're going to review that sales journal. You're going to verify shipments, like through the bill of ladings that we talked about earlier. We're going to test invoices. Are they calculated correctly? We're going to review contracts to check on pricing and commitments to see if potentially we haven't fulfilled a commitment, such as installation. We're going to check accounts receivable to see whether they exist by sending out confirmations, and I'll talk about confirmations in a minute. We're going to look at that balance for allowance for doubtful accounts. Is it reasonable, by looking at the aging report and kind of correlating it? We're also going to look for financial fraudulent transactions in the financial statements, such as journal entries. Any specific journal entries to accounts, subsidiary accounts. We need to understand why you would do that. Normally, the process itself should take care of that. We'll also look at subsequent events, in case there's large adjustments or large returns afterwards. So then when they had that big peak in sales at the end of reporting, subsequently, did they actually have returns or credits or something in the next quarter after the financial reporting that would indicate that there might be something fraudulent in the transactions? And those confirmations that go out, they can either be positive or negative. Positive is really the strongest one that the auditor has, because we want the customer to reply. So we want them to verify their balance, so they actually say, yes, that's my balance, and they'll also state any discrepancies if it's not their balance. A lot of times it could be timing. One of the big problems is getting them to return those. And that's why sometimes people will use negative confirmations, which basically says, hey, here's our balance, and if you don't agree with it, let us know. So obviously they don't have to send anything in that particular situation. And either either case is important to understand that you may really want a positive confirmation, or you may not be as concerned about accounts receivable. Maybe the risks are lower, so a negative confirmation is fine. And really, to understand the confirmation process, we're going to select our sample. We're going to send out those confirmations. We're going to receive back some responses. We're going to follow up on non-responses for positive confirmations, the ones that we really wanted to get a response from. We're going to follow up procedures for exceptions on those positive confirmations. What are we going to do if, for example, a big amount that we really wanted to positively confirm and they haven't sent us that confirmation? What could be some alternate steps that we could take? Then we might also have some follow-up procedures for negative confirmations in similar situations, just some large ones. They didn't reply. We just want to feel much better that that is a good number. What could we potentially do to mitigate our concerns related to that? And that's it for my presentation on the revenue cycle. If you have any questions, just email me at the Brockport email, or you can always give me a call or text me if you want to talk and let me know, and we can arrange a time. Either way, thank you very much for listening to this. And again, I'm here for you if you need me.